Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you, of course, from a sunny and beautiful Denver, Colorado today. And, of course, on a Thursday, I am running solo with all of you, but I am joined by my friend, fellow Schwab coach, Brent Moores, there in the chat. So take a minute, say hey to Brent as we work through our discussion today. He'll get to comments and questions I'm unable to, but I keep an eye on things kind of closely. Want to make sure that try to address things that I can for you live and in the moment. So if you've got specifics, bring those to bear here in the chat, and I'll try to do so in our discussion. If you're not already doing so, you can follow Brent and me on X, Brent Moores, CS, Kevin Horner, CS. Socials is a good spot to find us when we're not hosting for you here. I'm also available on LinkedIn, though not quite as active on LinkedIn. I do try to find a few good charts throughout the week and maybe expand the discussion topic where LinkedIn offers me that opportunity compared to X, which is a little more limited in terms of commentary available, but nonetheless, you can follow me there on either. Now, today we had heard from the PCE report a little bit in line with expectations, but also hot. Kind of a heads up that inflation's staying a little sticky. We'll see to what extent the market is reacting to that. And so with that, let's get to our disclosures and we'll move into charts. So please remember, everything we cover for you today should be considered informational and educational only. We do not make recommendations nor any endorsements for a specific approach to trading the market here. What we do, however, is incorporate technical analysis as we review the areas of the market. We offer insights, concepts, strategies that traders who utilize technical analysis may choose to employ themselves. And ultimately, you can do your own due diligence and determine which of these are the important factors for you, none of which are recommendations from us, of course, but really what we're trying to do is just offer you a multitude of ways to think about things and let you grab the ones that make the most sense for you. In terms of our agenda, we pretty much stay with a fairly structured approach here in Trader Talk. So we work through the major indices to start. We'll look at the S&P 500. We'll look at the NASDAQ 100, the Russell 2000. We'll talk about the recent move in yields as well. And then we will get to some stocks in the news today also. In fact, on a Thursday, one of the things I've been doing a little differently of late is trying to bring those individual stocks to the table and possibly submitting or at least discussing the potential for an example trade, what that might look like for traders who are wondering or looking for opportunities potentially. So you kind of utilizing stocks in the news to at least provide an example trade. And so I'll try to do that at the completion of the class here today. All right, and with that, let us take a look at how we're getting going in the market broadly. Here's our S&P 500. We're flat, down 0.0708, not much to speak of here given the move. We are holding our own up here. Each dip seemingly bought up quite effectively in the SPX. Everything we've talked about for the better part of the last 6 to 8 weeks remains to be the same. Essentially, 20-day moving average gently sloping upward. I say gently, but in reality, it's a pretty aggressive upslope, as you can all see here. The 20-day, we're a pretty decent move away. It's in the ballpark of 7,400. That's about 100 plus points away from where we are right now. So any drawdown to the 20-day could very well seem to be opportunity for participation for those of you who may be just kind of a little bit in disbelief still. The market will continue to confound the majority 100% of the time. That's a pretty consistent approach that the market likes to take, is to confuse us. But, the narrative around everything remains lots of risks detail available to us, and yet the market continues to trudge higher. And so, as always, what I like to bring to the table in this conversation as it relates to the broad indices is, hey, don't fight against what we're seeing. Let's try to continue to manage our positions effectively, staying long where we can, and not getting shaken out of positions that haven't broken down. If we look at the S&P here, you haven't broken down. You can be uncomfortable at these levels. You can take action to manage that discomfort if you'd like. One of the easy ways to do that, obviously, build cash, right? Remember, I've said it on numerous occasions, particularly in this class, that if you're feeling bearish, it likely means you're maybe just a bit uncomfortable with the moves we've made. If you're feeling bearish, you don't have to take bearish positions. Bearishness can be satisfied in some instances by simply building that cash and being ready to act when things do, in fact, pull back. So keep that in mind. You don't have to take bearish positions. You can be casual and comfortable and simply build cash in your portfolio by taking investment dollars off the table. And commonly, when you reduce the size of your positions and build more cash, you suddenly find yourself a bit more comfortable to stick with what you do have on the table, largely because that size of your position has shrunk, and thus movement in the market, in this case the S&P specifically, doesn't seem to impact your position the way that it once did. So just a thing that something that I have kind of learned about myself in management here. As I get those dollars to cash, I tend to be able to manage things a little bit more comfortably. So, 20-day moving average for many of you, 10-day moving average for some of you. You can see the 10-day kind of flattening out. If you're looking below us, we've got the RSI down there making a divergent high. So, of course, we made a higher high in price, but this is a lower high in the RSI. We can work these type of divergences off just by allowing time to pass, everybody. Remember, consolidations or support tests can occur by either price moves, big price moves, right, down to the 20-day moving average. That'd be a significant pullback, notable pullback. I wouldn't say significant because percentage-wise it's pretty limited, but you can also just kind of meander sideways, allow time to pass, and then we'll be finally seeing that if we went sideways but held this ledge here at 74.70, for example, went sideways for the next 3 to 5 sessions, you're going to find the 20-day moving average getting caught up with that. And then suddenly we're near the 20-day moving average and traders are going to feel more confident, maybe more willing to expose dollars. And that's just the way trends tend to work. Now we're going to see a lot of that same consistency, as you know, here in the NDX. Things have been a little bit more volatile, but everything that we say applies here as well. One key takeaway on the NDX, everyone, is yes, this is still a divergent high, and yet when we get the RSI over that 70 line, it certainly doesn't feel nearly as concerning relative to the divergence. And so some traders would look at this and say, yeah, it's a lower high currently in the RSI. Maybe this just means that time passing will allow us the consolidation we need as opposed to a significant sell-off. Now, one other key detail about this particular week, or this week specifically, I should say, is that we've got end of the month coming here with today, tomorrow, at the end of May, essentially. Not the end of the quarter, not quite as big a deal, but end of month after a substantial move in some of these positions. In particular, let's look at, just go back to April 30th here. The April 30 close was at, well, actually, I'm going to cheat. Forget it. I'm going to go with my labels here. So the month-to-date change, 9% on the NASDAQ here, okay? And the SPX, month-to-date, 4%. Okay, so we've had a pretty good move in the NASDAQ, pretty good move in the S&P, but the NASDAQ in particular, a 9% month, that is not all that common, and so it wouldn't be a shock to see a little bit of volatility at the end of the month here as the institutions are balancing portfolios and getting back to a comfortable level. Where you may very well see a bit more volatility could be in our small caps. Small caps have done well. Here, let's see what we've done on a month to date. 3.5% month to date because we were up a bit higher, as you can see at the end of the month of April, excuse me. Look, we were basically at highs in April. So even though the Russell is now, just yesterday made new all-time highs, the month-to-date returns don't look as great simply because they were at all-time highs at the end of April. So pretty good pattern here, development in the Russell as well. But it's probable that the key area to monitor today and tomorrow will be semiconductors. We'll talk about that in just a second, just due to the move that we've seen there on a month-to-date basis. A lot of those moves being extended, and some of those hedge funds and institutional investors might be dealing with substantial profits. Not only that, they might also be dealing with outweighted position size due to those strong moves. So they might be compelled to reduce the size of positions to get back into balance. This can happen in significantly quick moves, as we'll show here in the semiconductors momentarily. So when you're looking at the Russell, though, we've got that breakout level. We'd call this a little bit of a flag, 2-3 days of pullback. Not a big deal just yet. Looks like I got executed on one of my building a stock portfolio orders, so I'm going to need to make sure I talk about that one next Tuesday. And the Russell, let's see if the breakout level provides support, or if we've got to possibly see the 20-day. But the yields here pulling back over the last week have helped us, and today we jumped a little bit. We're going to see what happens here. This is a spot where we could very well see yields hold up, and if yields do get strong again here, where we get a rally from this 4.5 level, well, you can expect more pressure potentially on the Russell. It's very interesting to me that the Russell's made those recent new all-time highs, and yet the yields are elevated. And what it's speaking to, as I see it, I guess, is this expectation that our new Fed chairman, Mr. Warsh, is going to lead us with lower rates rather than staying the course that Fed Chair Powell had laid out, which was essentially data dependency. Let's see how things look. We're going to be patient. But if the expectation of the market is to get rate cuts, well, then perhaps what we're seeing is a willingness to buy up small caps and continue the uptrend there in the face of what yields are doing. So even though we have this market narrative speaking to that concept, everybody, I encourage you to continue to trade what you see rather than what we feel. What we feel often leads us into mistakes. I want to challenge that. I think as traders, we need to be far more disciplined, more black and white, right? We need to set our expectations and then stick with them as best we can, everybody. So I feel like that's the right approach. We'll see if yields come down organically here without Fed chair stepping in and making any changes. But again, expectations as traders are positioned are still very much in line with the idea of no change to the rate policy between now and the end of the year. So we'll continue to keep an eye on that. All right, I wanted to mention semiconductors. Let's talk about the stocks. We continue the assault higher. We do have a pretty clear divergence now. It's played out over the course of the last 6 weeks. And as you can see, guys, divergences don't seem to matter relative to the trend in the semiconductors, does it? We have made a tremendous move up. If we go to yesterday's peak from our bottom back here at the end of March, basically rallying in April, you're looking at an 83.5% move over what amounts to 41 sessions, 42 today. So what are we looking at? 8 weeks? That is just bonkers type movement. Now, again, the caveman brain says, hey, it's up 83% in 2 months. That can't continue. And you know what? You may very well prove to be accurate about that. However, you want to let market prices, market movement dictate when you decide to make your alterations and changes to what you're doing. One of those levels could be the low we just created yesterday. That's a nice new support possibly, as is the gap zone right in here. So maybe it's, if you're casual about it, it's somewhere in here, right? The gap distance right between it. It could also just be the last highs, and you could manage against those. Remember, prior highs, former resistance, can become new support. If we get down to this level here, and it happens to coincide with the 20-day catching up to that same 12,050 level, well, then that would be notable too, wouldn't it? That could also provide resistance. But, again, from a teaching standpoint, everybody, the reminder needs to be, divergences, bearish, bullish, they don't kill the trend, clearly, right? Now, they can be potential signals that things are shifting, but they are not direct correlation, right? So, a declining RSI might give you some pause, but the price action in the semis is really what should be focused on, right? Price is king all the time. So, yeah, maybe a little, Kelly, maybe a little self-control. Maybe you stick with it as best you can. Maybe you end up using strength to take position size off, reducing, the overall dollars you have invested, like I said earlier, as those positions that are doing well for you, as you shrink them by selling and taking a little bit of profit. It's amazing how easily you find yourself capable of sticking with what you have remaining, simply because the movements are not impacting your portfolio the way that they once were. You're taking a little bit off the table, it's shrinking the position size, and now those back and forths aren't showing up the way that they did previously. So that can be a really a good reminder of how we can manage our emotional process with our trading. And of course, that being such a key component for us as traders, in management of emotions, that is. So, okay, there's a look at our semis. Now, I'm going to, before going to the transports, a group that is so heavily tied to oil prices, let's take a second and look at oil. We're going to use the future symbol on this, so it's /CL for crude light. This gives us a good indication of how oil is acting. And reminder to all of you is that while we're utilizing a futures symbol, we are not advocating for trading of futures here. I am utilizing this simply to understand the relationship of oil's move to that of the broad market. And I think the biggest takeaway as I zoom in here, everybody, is this week we fell out of the continuation triangle. Why do we call it continuation? Well, how did we come into it? It was a bullish move to the upside, and then we have spent, since that ridiculous peak in early March, we have spent the last 2 months almost, now 7 weeks basically, consolidating, right? Going into lower highs and higher lows, essentially creating this triangle, this pennant. And for a lot of traders, you're simply waiting for the move outside of that pennant, and that's what we've gotten this week, 3 days outside of that uptrend line. This is a positive as it relates to the broad market. We like to see oil coming down for obvious reasons. It is a disinflationary concept for us, and if we can keep oil under wraps or at least cease making higher lows as we have, obviously we've got these lower highs, so we have the potential for a breakdown. Obviously, we've got the narrative around the potential for the conflict coming to an end. We'll see if that actually plays out more than just headlines and commentary out of the administration. But some solution there could easily lead oil lower. And oil lower would obviously be beneficial to transports. So let's talk about the transports here. Here's the broad index looking at the group. Remember that transports are essentially our big 3 groups in this section. We talk about roads, so truckers, rail stocks, as well as airlines. Now, recently, we've noted airlines making a pretty good move. I'm going to zoom in here. We see that we have a throwback. Let's just throw up just the 50-day. Our throwback move to the 50-day moving average, our prior highs. Basically, we had this move through resistance. These were all-time highs. We took out resistance. We rallied aggressively. Let's put a percentage on this. And granted, I know this kind of goes back. This was a big move tied to Avis. Remember, Avis CAR had that huge move, that short squeeze. A lot of this had some tie to that. But from a technical basis, a huge 26% pop. And then what did we do? We came all the way back to test support. So prior highs, prior resistance became support, in this case coincident with the 50-day moving average, and now you've moved off of it quite nicely. So you're improving here. And I also want to point out that volume in the buying here has been of late positive as well. Some good spikes kind of validating the moves, which tells us it's not you and me paying close attention. It is likely tied to our institutional traders. And obviously, that's a positive as we try to follow the so-called smart money. Now, if we take this outside of the transports broadly, let us look at our airline stocks. So airlines have been popping as oil has retreated. So with 3 days below the triangle, what you've seen is airline stocks jumping as a result. So you've had a pretty good move here, took out resistance, popped up pretty nicely to the peak just yesterday, about a 10, almost 11% rally there in airline stocks. Nice to see that. We also could see, let's take a look at our trucks. Something similar here. There's real constructive trend on this one, everybody. I've drawn it in with my all of my lines, but I'm going to clear this out and just make note of some very standard, basic technical analysis. We don't have to get cute, everybody. We can stick with the standard concepts, right? Breakouts and throwbacks. Former resistance, now potential support. Good move from here to the peak. And then we just needed a breather. We brought back to the 50-day moving average here and have held. And then once we broke this little angular level here, we've had a continuation of the move. So truckers moving with the fall in oil as well. However, I want to point out, look at this move here. This is mid-March to the peak in, well, let's just call it late April, okay? And the truckers moved up 30%. Now let's go back to oil and let's just see here, mid-March to the end of April, what was going on. So March, here we are, March around middle of the month. Here, if I can get off that, there we are. All right, so the middle of the month, we were right in here. We had a slight pullback, but look at what happened. Oil popped aggressively from March 20 to early April, I should say. And it was then after that big spike where we came all the way back and we made a significant drawdown to basically to the end of the month. Well, it was that drawdown, it seems, that really played well into the trucks there. So that pullback in oil, aggressive as it was, 25% pullback from that short-term peak, really gave a boost to trucks. And so if you're looking at trucks, rails, air stocks rather, make sure you're monitoring and keeping an eye on oil. Now, the rails, I wanted to point out, has been in a pretty interesting move itself here. We've had a hold of a area of potential support up here recently. This looked like a bit of a bull flag, right? And then we broke the bull flag to the upside, and now we're coming back for a test. Not that that should be a shock, but you've got a level of potential support here in your railroad stocks, and a 50-day moving average is not apparently key, right? Because look at what's going on here. We have been, for a multitude of instances, below the 50-day moving average. Now, one other thing that's jumping off this chart to me, I'm going to take this channel. In fact, let's do this. Let's go back to make this a 2-year pattern. Okay, now I'm going to extend this line through here. Okay, this is another line for monitoring because we were in a very clear and distinct channel until we got outside of it. Now, this move was interesting because it brought us all the way back to the bottom of the channel before getting strong again. But we did get strong, and we made new 52-week and all-time highs. Now, the fact that we are outside of this channel again and have held outside of this channel can be notable for us. So let's keep an eye on that because you'll see as I zoom in, look at what's going on. We're basically allowing all this price action to get caught up, and what we are creating is a significant area of confluence. Remember, confluence just says we get traders relying on multiple signals that tell us multiple details, and they are all looking at the same price level. That can be very helpful for us, right? The more traders in various time frames and various reasons and instances that are watching the same level, the more it may strengthen that area as, in this case, support. Further, what it says is that under this zone, it would be a significant development because traders in a multitude of manners and fashions are watching this exact same thing. And if it changes, if it breaks down, that becomes an area where many traders become willing to take some semblance of action, right? So very important as well when as it relates to transports. All right, so we've looked at the S&P, we've hit the NASDAQ 100, the Russell 2000, the semis, the transports. We've looked at the three legs of the stool in transports as well. Let's spend about 5 minutes taking a look at our sectors before we move to stocks in the news. Now, first of all, we'll work our way down with energy. Energy still letting us know that it's an outperformer, but the most recent action is defining a new channel itself. You'll notice we did not make new highs, right? We made matching highs on this bounce, but ultimately this is the new trend to keep a close eye on. We do have horizontal resistance at the last high, horizontal support at the last real low. And the main detail here that we want to take away is, are we simply going to believe in the new short-term channel that's developed, or do we need to pay attention to our most recent high, our most recent low? That's going to come down to how you evaluate or prefer to trade. But for a lot of traders, simply keeping an eye on this channel will help you out right now. Obviously, a move below the channel, outside of the channel, could easily bring us back to matching lows that we've seen over the last few months here, okay? So we'll monitor that. Obviously, this will have a key link up with crude. So if crude does drop, you could certainly anticipate perhaps energy getting a deeper pullback than what we've seen. Moving on now, materials. This one has really fallen out of favor. I'm going to look at gold and silver with you as well, just as a reminder. But there's just not the enthusiasm that once was there. And you can see it playing out in the way of price action. Again, a gap move lower, a big rally, but all we did was rally into resistance, right? We have not gone anywhere in price since the breakdown. So the fact that we've rallied and made a lower high, that tells us that we don't have a clear, well-defined uptrend. Now I can draw another trend line through the recent lows, and so you've got some levels to monitor here, if nothing else. Taking out the uptrend line that's been working since November of last year would be a significant development on materials. Moving on through, you've got industrials holding the 50-day support pretty well established at the 50 or recent lows here. Well, let's see about discretionary moving to new highs yesterday, or at least dabbling. We are close to a potential breakout in the discretionary space. If you take a look at this one on the weekly, everybody, you'll see that it looks a little bit cleaner even, doesn't it? Goodness, if we can just get through this area to make new highs, yeah, we could see discretionary kind of taken off. I'm going to draw another channel line here. So you're looking 1690. It's about a 300-point range, approximately. And you all know, if we're watching it from a range standpoint, that's one of the things we could give consideration to, right? Is, hey, if it breaks to the upside, do we possibly have the height of our range available in the next move, the so-called measured move target? The reminder I have to offer, remember, we can't guarantee any measured move, whether I calculate it or you calculate it. It's just not a guarantee, but it is a way that we can try to target our upside opportunity. In this case, our upside opportunity, because if it breaks to the upside, that's what we'd be looking for. If it were to break to the downside, we'd have to give it maybe 300 that direction, right? 1700, possibly down to 1400. Where would 1400 reside, by the way? Oh, look at this. Pretty close to those last lows. So when the math always maths and it makes sense, that's always helpful for us as traders, right? I kind of like to see that the levels make sense. Prior resistance, it did become support here. So if we broke down, could it be support again? It certainly could. All right, we'll see what happens on discretionary. Moving on, we've got Staples trying to stay positive here, right? Trying to hold the 50-day moving average. We talked a little bit about this one over the last week because it is improving. We've had a good move to the upside and a good pullback about halfway. In fact, we know that maybe when rallies occur, we can get a 50% pullback and stay within the trend. We're a little bit below 50%. We're actually dabbling at the 61% retracement of this move. This is a good line in the sand for a lot of traders, not all traders obviously, but when you take that 61.8%, a lot of traders will tell you that that's the most they'd be comfortable giving back in an upward move like this before saying, all right, under the 61.8, I'm no longer as confident that it can keep going. So that stands out. That's the fact that it happens to be coincident with the 50-day moving average might even strengthen that level as support. And if it doesn't hold here, well, then what do we expect? We expect a possible pullback to former support, right? And so we might be looking at matching lows. And again, I'll remind you, as we often say in this class at least, matching lows are cool. Lower lows, not so much. All right, next up is healthcare. I've been talking about healthcare. It's trying hard to move out of this range, everybody. Look at where we are. We are right back to short-term resistance. We've made matching highs. Matching highs, they're cool. We'd rather make higher highs, right? So we're hoping to see healthcare move through this if you're long healthcare, if you want to be rooting on healthcare. If we get a move to the upside, we should expect a breather at possible resistance, and that could be this former support. So you've got a little ledge up there. So we could have maybe a 40-point rally in the group here if we can pop through short-term resistance, but we are above the 50-day now, and you've been above it for about 6 or 7 straight sessions. Traders are probably taking a little bit of comfort and confidence from that one, given the recent move here. So again, look at this 50-day moving average, everybody. We got above it in August of last year. Support. We're dabbling. We couldn't. We're below it, but then we made a matching or maybe even a lower high up here, and then it resulted in a pullback. And certainly your sell signal was when we traded below horizontal support, and it moved. I wonder, did that make the measured move? I think it made at least the measured move, didn't it? Let's see. Take that line. Yeah, it made more than the measured move, everybody. So, yeah, watching the breakdown here could have been very instructive on healthcare. All right. Let's see. Financial still trying to tell us there's nothing to see here. Everything is fine. Holding the 50-day, another 50-day support test just today. That seems notable, as does the curvature of the 50-day. Look at that lovely little kind of a rounded bottom, so to speak, here in the action of the last 5 to 6 weeks. This is a well-developing improvement. It's just taking its sweet time, isn't it? Now, if you're the trader, this level, the fact that you've tested the 50 could give traders confidence and willingness to step in simply because what are we seeing but a good risk versus reward? If you're a believer in the 50-day, closes below the 50-day could easily kick you out of any new trades you put on. But this is an improving chart. Remember, downtrend once broken can become an uptrend. And the fact that we've not, even though we've made a short-term move to the upside and we've not exactly seen explosion, the fact of the matter is, everybody, all of this action is positive simply because we broke the downtrend and have managed not to give any back. We have held our levels here. This is a positive for financials. Let's see if that persists moving forward. All right, tech. I mean, what else are you going to say? Bull flagging at resistance at all-time highs. Tech has been on just an absolute terror. We're going to love it until it changes. Monitoring here, 10-day moving average can be working, and as can the 20. It's all about your preference, everybody, and your time frame confidence. 20 here was kind of resistant, but I'll tell you what, this looks like maybe a 30-day moving average could be a bit more effective. Let's just see. I always like to play with my details a little bit because we learn something when we alter our like our moving averages here. You can see that the 30-day has been a little bit more consistent as resistance, and then now, I mean, it doesn't necessarily change what's happening with support, right? It gives you a little bit more wiggle room, but some traders will call out the fact that we do have a level here, could be considered support as well. But a 450 to 500 point pullback from our current prices in the space wouldn't feel great. The last three here, how about communications? Interesting that this is consolidated. Remember, I was saying earlier about consolidations can come in the form of price or time. This has been a time consolidation essentially because we've just moved sideways for the better part of this month. And we've made new short-term highs, but it hasn't exactly exploded. So this looks like a time consolidation, allowing the 20-day to catch up, or in this case, the 30, because I haven't changed it. Let's go back to the 20. There we go. Allowing this to catch up and basically validate the trend. So some traders are going to watch this line here for indications. And then our two that are very intriguing, of course, utilities lagging, yields remaining a little bit elevated, putting some pressure here. But if we are believers in yields falling, we may very well see eventually utilities getting back into gear. The last one is the real estate group. The real estate group, largely that of real estate investment trust as opposed to actual real estate. Remember, real estate, housing, that falls under discretionary. These are more likely tied to your commercial real estate trusts and whatnot. And those, of course, carry a different level of risk. So make sure that if you're a REIT or interested in REITs, you're doing your due diligence, you're diving into the risk factors. There are many associated with REITs that do not apply to standard equities. And with that, let's get to some of those stocks in the news for you, everybody. A couple of movers here today. So we had I wanted to make sure we got some upgrades for you. Upgrades in the utilities energy area of the market. We had Quanta Services was upgraded at Oppenheimer to outperform from perform. They were noted as a price target of $800 following a transfer of coverage here. So the company, Oppenheimer, that is covering this newly. They state that Quanta specifically positioned in markets with superior growth prospects, according to the analyst in their research note. They say that Quanta's exposure to power generation, complex facilities development, underground delivery network modernization, and pipeline are all necessary to support electrification demands for AI development specifically. That's leading to their upgrade here. Now, the stock is not reacting the way you would like. It's off 1.5%, but maybe more broad market weakness or even sector weakness this morning as compared to individual equity weakness. Now, we had a previously reported deal perhaps with Dominion and NextEra. I want to look at those two in a similar space here. So here's Dominion. Dominion recently had this big gap up, and I believe this is tied to the agreement, but Dominion was upgraded to buy at Jefferies after the NextEra deal. Previously reported, Jefferies upgrading Dominion to buy from hold. Price target of $76. That's up from the previous $65 following the NextEra Energy acquisition deal. It's not a according to Jefferies specifically, this is, quote, not simply a merger or arbitrage view, and that the spread is too wide, according to the analyst. But he states that Dominion is, continuing the quote, worth materially more than before. So that's the reason. So basically what we're reading is synergy from the deal leading to Dominion getting the upgrade. This looks about as much like a bull flag / bull pennant as you're going to find. Big pull here. So, looking for a breakout of the pattern. Above the downtrend line or below the uptrend line will define how many traders will take that for you. So keep that in mind. Let's see if on this on the weekly. Now you've got a really improving chart on the weekly, don't you, everybody? Long-term uptrend in play. That's pretty notable here. So keeping a close eye on Dominion. Let's see, if that rolls to the upside here. This is a pretty good flagpole that's built in. All right, some other ones that are moving. We had, one that I haven't talked about much lately is First Solar. First Solar just cruising here. First Solar was upgraded to buy from hold at GLG Research. Their analysts upgraded First Solar to buy from hold with a target at 315, which is up from just shy of 208 previously. So that's a nice upgrade, almost a little more than 50%. The firm is citing the cancellation risk of the company having been resolved and having been, let's see, their company's Series 6, it's a copper replacement, having been launched at its manufacturing campus in Ohio, in Perrysburg. So they like that, and the stock has done exceptionally well of late. Remember, from a technical perspective, everybody, what did we get? We got a break of the downtrend. Commonly, the break of the downtrend is a spot where some traders will get started on some of those trades, right? And once it got through it, it's just been not straight up, but constructively up. Rally into resistance and pause. Rally through resistance and pause. Test horizontal support, test the 200-day, explode to the upside. We like that type of action that gives you opportunities to participate. If you missed, one of this day here, all of these, you're back to, if I'm not mistaken, pretty darn close to all-time highs. Now, that is a quite constructive weekly look on First Solar. Wow, what a move. All right, a few minutes to play with you all here. Let's see if I've got other alterations, other stocks. We had some price target movements here. Broadcom had a price target raise at Susquehanna. So let's take a look at AVGO. All right, Broadcom was raised its price target to 490 from 450, citing, according to the analysts at Susquehanna, the firm updated its model ahead of Q1 results, where XPU momentum is expected to continue amidst TPU strength. So demand for AI networking products should expand further. There's a reason for an upgrade. We have another price target bump in ARM Holdings. Goodness gracious. Talk about a move through resistance, just moving and going. This one added 100 points, everybody, since breaking all-time highs. Broke all-time highs and went up 100. Not too shabby. Holy cow, what a range, huh? Look at that. Big moves out of the range. We're at 84 to 180, 100 points, and then it quickly went to 280, and now it's at 320. I mean, we can put all the measured move targets we want. Sometimes they're not going to stop the stock from moving, and sometimes the stock doesn't even get there. I always find those to be pretty intriguing. So, all right. And then one more. Price targets were bumped up in Synopsys. This one is taking a breather after all those price targets. So you've got the earnings, basically was a sell the news type of a move here. Now this is intriguing because it is getting all these upgrades and, or pardon me, not upgrades, but price target lifts, and it is breathing a little bit. And so I thought this one would make a good sense to possibly put on a trade where we put a trade beneath, basically an exit under the 50-day moving average at 460. So this one is falling, and that'll give us a chance to participate. But I want to incorporate the ATR, which is just shy of $17 down below. So quick math says from 460 down $17, that puts us at about 443 for an exit strategy. It is risky about $45 a share. But if this is a new uptrend in play, then we've got an opportunity. Now, this is going to be a small position that I just want to put on with a stop order about 17 points under the 50-day moving average, because if we believe that this is all valid and should be the new uptrend here, well, then we don't want to stick with it below the 50-day, and using the average true range will increase our likelihood that if we get taken out, it happens at a time when the stock is more likely to revisit lows than it is to hold up. So that's the concept there. We can do it for a very quick 5-share trade. Or actually, excuse me, let's do a 10-share trade on this, but we have to do it with our brackets. So I'm going to right-click, buy custom with stop. Now that is not going to give me an exit strategy to the upside, only to the downside. I'm going to say, let's do this for 10 shares at market, which will get us into the trade right away. And then we will protect ourselves down to 443 with a good till canceled stop. I'm going to come beneath that by some pennies because I don't like working with zeros and fives. I like to get underneath those. So odd numbers. But remember, that's a trigger price, everybody. And I have no guarantee that once triggered, it's going to sell at that price, because market price is what we get. So we'll watch this one. Let's see if we'll find this one kind of getting back into gear following its earnings announcement. But we're going to give this one a wide berth. We'll watch this one separate of my building a stock portfolio class. We'll see if this one carries for us. So there you go, everybody. That's going to put us into the trade right away. There we are. We've got a small trade working on Synopsys. Let's see how that goes. We'll speak about that one in future segments as well. All right, so with that, we are at time, everybody. As always, really appreciate you joining me, particularly on a Thursday when I'm running solo with all of you. Big thanks to Brent there in the chat. Lots of discussion going back and forth here, and I see that we do have the S&P popping as we speak, so nice to see both the S&P and the NASDAQ flipping green at the conclusion of the class. So we like that. If that's in fact the case, then yeah, maybe if there is a deal, yeah, you could easily see a market continuing to pop. So we'll got more to come for you here all day today on the channel, as you know, live content. So stick with us here, everybody. Follow us on X. Hit that thumbs up button for us down below if you like the conversation today. And with that, I'll leave you to it. Have a great Thursday, everybody. I'll see you again real soon.